Today, post-election bump, reality or mirage? Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. We're now starting to get data from the post-election period. So today we look at the latest from our Household Finance Confidence Index, which shows a small bounce but remains in below average territory, and the latest NAB Business Conditions Survey, which shows again a slight bounce despite reporting underlying conditions weakening. So we're going to look at the data in more detail. But so far it seems to me that there is very little evidence of a substantial change in momentum, which might point to hopes of home price recovery being more mirage than reality. We've released our latest Financial Confidence Index, which is derived from our 52,000 rolling household surveys. The index moved a little higher since the election, reflecting some more positive vibes from property investors at the margin, and from those holding property more generally. But it's all relative, however, as the current read is 86.34 and up from April's 85.9, but the overall measure is still in deeply negative territory. Looking at the segments by wealth, there was a bounce in those with mortgages and also those renting or living with family or friends, but again, still in negative territory. Those with property and no mortgage hardly reacted at all. And analysis across our property segments shows a move up from property investors now expecting no changes to capital gains or negative gearing, and a slight improvement from owner-occupied borrowers, and a kick up from those renting. By states, the convergence of recent times continues, although New South Wales and Victoria saw a slight improvement, while Western Australia and Queensland saw a deterioration, which are linked to higher default rates in these states. Younger household scores fell again, but there was a bounce in those aged 40 to 50 and those aged 50 to 60, directly linked to the slight change in property investment sentiment. Within the moving parts, there was little movement in job security, with 36% still feeling less secure than a year ago. Public sector jobs in particular now look less secure. Savings remain under pressure, with lower rates on bank deposits, although higher returns from shares. The prospect of lower deposit rates took the less comfortable rating down 2.88% compared with the previous month. Debt remains a concern, with 47% worried by the amount of credit they hold, while 49% are feeling about the same as a year ago, which is down 2.6% on the month before. Income remains under pressure. Given the lack of real wages growth, this should be of no surprise. 40% said that they had seen no change in the past year, and 50.5% said in real terms their income had fallen. On the other hand, costs of living remains a challenge, with 91% of households saying costs have risen over the past year. Electricity, childcare, health costs, rates, and food all registered, which suggests that the CPI continues to understate the real experience of many households. And finally, net worth deteriorated for 46% of households compared with a year ago, thanks to falling property prices. 26% said there was no change, and 24% said that their net worth had improved, which is down 1.63% on last month. Stock market performance helped to offset the property falls. So the question becomes, will the slight tick up in property-related sentiment stick, or is the overall index sector fall further as reality dawns? Low incomes, rising costs, big mortgages, compressed returns on bank deposits, and weaker job prospects? Put like that, the small falls in mortgage monthly repayments, some tax credits, and income uplifts for some may not be sufficient to support the index ahead. We will see. Turning to business conditions, the NAB Business Survey for May reported a bounce in business confidence following the 18th of May election. The Business Confidence Index jumped 7 points to +7. But as it is coming off a weak starting position, confidence just lifted to be about average. This was before the RBA cash rate cut, which may have helped to lift sentiment across all states. Industry-specific analysis shows that while the jump in confidence was widespread, manufacturing was little changed, while confidence in finance, business and property sectors showed a noticeable bounce in the month. Of course, this is in reaction to the hope that cutting rates and removing the risk relating to negative gearing, etc., may lift property sentiment. But as the AFR put it, the post-election housing euphoria has fizzled out into a state of calm and caution, with agents lightening the market to a shaken can of Coke. When you take a can of Coke and shake it, it explodes and then starts to flatten out. That analogy is quite appropriate for the market right now. My agents say there was a bit of hype, but it's settled down a bit now, as one industry insider was quoted. But the key question is, of course, will the jump in business confidence be sustained? While more expansionary monetary and fiscal policy will help to cushion the economy faces some key structural challenges like weak productivity growth and persistent flat real wages, which have actually been there for the last 5 years. And to that end, it's worth looking at actual business conditions because they weakened in the month, dropping by 2 points to only +1. This is a well below average reading. Forward orders reportedly fell at a sharper pace in May, down 1 point to -3. Trading conditions were down 5 points in the month to +3, and profitability fell 4 points to -3. Employment conditions and capital expenditure were down, but the downtrend in employment conditions remains firmly in place. The index, having slumped in April, down 7 points to -1, managed only a partial rebound up 3 points to +2. And the report suggests that this is consistent with jobs growth near term of around 18,000 a month, which would see the unemployment rate stagnate or worse. While capital expenditure bounced in May, this is such a volatile series that it may only be noise. But the industry story is a significant concern. Retail, for example, conditions plunged to -27. So standing back, it looks to me that any bounce is more mirage than reality. And both on the household and business side of things, it's looking pretty tough. Worth remembering this data point from the recent GDP series. In the past quarter, nearly 80% of economic activity came from the government sectors. Business and households fell off a cliff. And we think there will be more of the same. Now, tell me again why home prices are set for miraculous recovery. Just don't hold your breath. And before I go, a quick reminder that next Tuesday, the 18th of June at 8 p.m. Sydney time, we're running our next live stream event and Q&A session. You can ask a question via the live chat during the show, or beforehand by sending me a question via the DFA blog, links below. Mark your diary. It should be a fun session. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.